So, one of the big headlines dominating today is the idea that mega investors are snapping up homes across the United States in popular metros, in some cases, grabbing as much as 30% of the sales happening in those markets. Now, this is a headline that's been around in the US for approximately 10 years, actually a little bit over 10 years. And we're going to dive into the history of really the explosion of institutional interest in single family rental home ownership. Now, that said, the problem really boils down to what's real here and what's like clickbait, right? It sounds alarming to say 30% of homes are selling to investors, but national investor activity is uneven. In other words, these headlines are really talking about some specific metros, but the SFR story, the single family rental, when I say SFR story, is just simply much more nuanced than is being presented. And as they say, in the headlines, right, it's that clickbait. If it bleeds, it leads. There's a little bit of scare tactics happening here. So it's important to use real data and a historical lens to separate the signal from the noise. Now, what we're going to dive in today is what's actually happening in these hot metros, how we got here, and what it should mean for you as an investor. Now, you can invest in real estate with all the headaches and stress that can come from doing it yourself. Everything from finding a good deal to arranging financing and managing tenants and renovations, it can take hundreds of hours. So why not join the 200 plus investors that have already placed their trust in Ferris Capital Partners? At Ferris Capital Partners, we invite you to join us investing in incredible deals in high growth, landlord friendly markets with incredible upside. And the best part, when you invest with us, we do all the work and you sit back, collect your monthly cash distributions, and participate in the upside when we sell. So if you're interested in learning more, go to fulloutinvesting.com. We have a sample deal deck and you can book in a time to talk with us to learn more. So what are the current headlines really saying? So just recently, there was an article in the New York Post, for example, and it was highlighting that mega investors are gobbling up to 30% of the inventory in select metros. Now, some of the metro areas that were mentioned specifically are markets like Atlanta, where I live, Memphis, markets in Texas, and in the past in Florida, although investor activity in that market has started to cool. But here's the context that was missing in some of these articles. If you actually look at history and really even just year over year, investor purchases of single family homes have actually fallen by 6% comparing Q2 2025 to Q2 2024. And it's at the lowest level in the spring in quarter two since 2020. But the reality is investors are still buying up a lot of homes. But this is where we have to sort of separate the headline from the reality, which is that what we often focus on are the large institutional investors that are certainly in this game. And we're not really talking about the majority of these homes are actually being bought by folks like you listening to this podcast today. Just, somebody who's grown some wealth and is looking for ways to diversify. And they think about real estate as a great opportunity, which I would highly suggest every investor listening to this consider real estate for diversification purposes. In fact, we're going to dive into that topic in another podcast here soon. But it's not all going to these institutional investors. So the headline is, private equity is buying up all these homes. But let's look at the real numbers here. But first, we're going to start with some history. So really sort of during the Great Recession, home values dropped dramatically in the United States. In fact, it was the first time in history that home values dropped in the US across the board. Now, certainly there's examples where you might look at a certain metro, Detroit being a great example. It's so heavily reliant on the auto industry. When there's a recession, that particularly impacts the automotive industry. You see depreciation in Detroit as people move out looking for other jobs. So there were specific pockets that may experience depreciation due to economic factors, major employer leaving, or a down cycle in the economy that particularly impacted that one region. But the Great Recession was the first time it happened nationwide. Now, of course, if you're listening to this, you probably already know the Great Recession was largely caused by the housing industry, right? Lenders got loose with their lending standards. There was this high demand for these mortgage-backed securities. And so we started doing all these subprime lending. And of course, now we know the full story, right? You can read Michael Lewis's incredible book, The Big Short, or watch the super entertaining but also informative movie and really learn how all this came in. But because of the dramatic drops in values of homes, what these institutional investors realized is that homes were now selling below replacement cost. Now, interestingly enough, at Ferris Capital Partners, when we buy an apartment building, that is one of the metrics we look at. Are we getting a discount to replacement cost? And so that was one of the number one metrics these groups looked at. In fact, I actually had a front row view of this because at my prior company, Mark Spain Real Estate, we actually worked alongside many of these institutional investors as their broker, helping them find these opportunities. And I can tell you firsthand that groups like Blackstone, America Homes for Rent, Colony Homes, some of the early players in this space actually moved the market and helped correct some of the challenges. They were buying up so many homes, and because of their strategy and their focus on buying below replacement costs and getting a lot of those homes off the market, it helped to limit the inventory, which balanced supply and demand, which helped home price recovery, which eventually helped many people that were underwater on their mortgages get back into a much better place and avoid something like foreclosure. So it was not all great, right? I mean, certainly they are taking homes off the market for a potential homeowner to buy. But I guarantee you, without the presence of these institutional investors, sort of starting in 2011, 2012, 2013, we would have had a much slower housing recovery. That's just my 2 cents. But having been there on the front lines, I saw it happen myself. Now, I mentioned Blackstone. So that their shingle was called Invitation Homes. They acquired a company called Treehouse Realty Group, rebranded it Invitation Homes. And, in the headlines, you often see they focused on foreclosures. Now, that is true to an extent, but they also would buy homes that were just on the market for sale. And they were looking at things, once again, like replacement costs, but obviously they were chasing a cap rate. They wanted to put a renter in there, make sure their money was working for them. And part of the idea was to basically make a product very similar to an institutional level apartment, but in the single family home space. So they would renovate these homes and bring the standards so they were very consistent across their portfolio. And the idea was they were going to buy homes all over the US and hopefully treat residents really well. So if somebody moved from one market to another, they could just go to Invitation Homes website and know that they're going to get a very similar product, similar finishes, and a similar level of service. So in a way, it was no different than buying apartment buildings. They were just buying single family homes at scale. America Homes for Rent was another one. They were one of the first in the space. And they aggregated their portfolio into a REIT. And by 2017, they owned over 50,000 homes across 22 states and are continuing to purchase today. Now, what's starting to happen is many of these groups are actually out of the game of buying individual single family rentals. They're now in the build to rent space. In other words, they're developing whole neighborhoods and communities of either single family homes or townhomes for the purposes of renting. So that build to rent is becoming much, much bigger. And we're seeing more and more of that activity. I actually remember being in Charlotte. This was probably back in 2013 and seeing the first community I'd ever driven by with a big sign. And you think it's a for sale sign and it says homes for rent. And just thinking, wow, that is so strange. Who would have thought of that? I couldn't imagine that. Now they're everywhere. In fact, Noonan, which is an area we have an investment we're about to close on, and it's an apartment building. Most of the new inventory being built are these build to rent communities. And why that makes our deal so attractive is because building a single family home or building a townhome community is much more expensive than building stacked apartments. And so their rents are much higher. So we're going to offer a very comparable style of living at a much lower rent. So it's actually part of our business plan and thesis on that particular investment. But once again, let's look at the key context here. Today, institutional investors, and you have to look at different data sources. I've seen everywhere from 2% to 4% of the single family home rental stock is owned by these large institutional investors. So in other words, the great majority, the overwhelming majority of single family rentals are typically owned by what we would call more mom and pop investors, folks like you and I that just have built up some wealth and decided to invest in real estate, maybe buying a couple rental properties, whether short term, long term, or maybe even doing fix and flips. Owners of properties that own more than 1,000 homes only account for 1% of the rental housing stock in the United States. So that's where I think it's just really important to say the headlines are going for the clickbait, right? Institutional investors are buying all the homes and making home ownership unaffordable. Which the problem I have with that is that there could be a contribution there, to be clear. I'm not saying there's not, right? If in Atlanta, 17% of the homes this year have sold to investors, which is a true number, that is taking homes off the market that a homeowner could potentially buy. But the reality is the bigger issue is the lack of new quality product being delivered. And there's a myriad reasons for that, right? High materials costs, high land costs, high regulatory costs. In fact, on a recent podcast, we dove into a proposed emergency order the Trump administration is considering to try to wake the country up a little bit, get local governments to start looking at some of these regulations, at a minimum, lower some of those regulatory costs, and potentially even open up some federal land or unused federal buildings for reconversion, thereby lowering the land costs. But as I discussed on that podcast, what they haven't addressed and what I haven't heard talked about is how the tariffs that Trump's administration has implemented are impacting the cost, right? Homes are largely built through copper, aluminum, steel, lumber. Many of these things, majority of these things we're importing into this country, right? And so with these tariffs, that will drive up the cost. So you might lower the land costs and potentially lower some of the regulatory costs, but the materials costs will continue to rise. And I do think because of the immigration policies, we'll also see a lift in the labor costs. So the challenge we have in this country and in Canada is really about the cost of building a quality new home or apartment building, less to do with who owns those buildings, in my opinion. So where are mega investors, sort of active right now? So according to Redfin, their Q2 2025 data shows, 17% of homes nationally were purchased by investors, with some metros ranging from 8 to 30%. Florida metros saw some of the bigger declines. I mentioned earlier, Florida was a hot place for a lot of these investments, but it is starting to cool off a little bit, largely due to the rise in insurance costs. Now, I will say personally, we do own assets in Florida, and we've seen significant savings year over year from when we initially purchased the asset. The story in Florida is obviously we had a few major hurricanes over the past 10 years. Insurance rates rose as carriers left the state due to too much exposure, or maybe they got nailed in one of these big hurricanes. But what's starting to happen is the free hand of the market is acting. Carriers are coming back in. There's more competition. And despite Helena and a few other major storms last year, Florida was largely shielded from that. So we're hopeful as we sit here recording this in mid-September. So far, hurricane season has been a little bit lighter this year, but we still have some time to go. So we watch that very closely. But insurance costs are keeping a lot of these institutional investors out of Florida going forward today. In parts of Texas, for example, like in San Antonio, institutional shares have actually started to tick back up again modestly, reflecting once again pro-growth fundamentals, landlord-friendly policies, a lot of the things that we look for here at Ferris Capital Partners. So what does this mean for investors, right? So, when you see 1/3 of sales are going to investors, right? Local spikes don't always equal national dominance, So if you're thinking about investing in a market and you're saying, gosh, can I compete with these institutional investors? Bottom line is you really got to get into city level and some market level data and comps, not national averages. Real estate is local, local, local. And when I say local, I don't even mean the metro area. I mean, sometimes depending on where you're at, it could even mean just a few block radius, right? There's many cities and metros. Atlanta's a great example where one neighborhood within the city of Atlanta could have incredible fundamentals, and 2 streets over could be problematic, right? So it's hyper local. And so if you're thinking of investing in market and you're seeing these headlines and you're worrying, should I or shouldn't I? Dig into the city level data, drill down into the submarket, the particular neighborhood, and look and see what's actually happening, right? And supply pricing, like rent dynamics, right? If large buyers absorb inventory in a submarket, first time buyers may face tighter supply. Therefore, it's harder for them to buy a home. The reality of that is, what is their alternative, right? Everybody needs shelter. So that means they'll be looking for higher quality rentals. So that may mean they rent from one of these single family rental groups, could be an institutional or one of those aforementioned mom and pop groups, or it could be in an apartment owner like Ferris Capital Partners that's providing super high quality yet affordable apartment options, right? So we take a look at this information. Even though we're investing in apartments, we want to know the overall story in that submarket. So we're looking at the rental pool, regardless of the asset class. If it's a single family build to rent, townhome community, or there's a large supply of single family rentals in a particular area, we're factoring that into our underwriting just to make sure we're looking at the right flow of supply and demand. In other words, if we just looked at what's happening within the apartments, we may miss something. So rest assured, we are digging into this data. And so in terms of you as an investor, what should you be thinking about? Well, our thought is you definitely want to invest in multifamily. Just the nature of multifamily, you have, in some cases, hundreds of units. So if you have a little bit of a dip in occupancy, or maybe some residents that are not paying their rent on time, the property can absorb that and you're still cash flowing on a regular basis. In fact, many of the assets we buy, our break-even occupancy can be in the 60 to 70% range. So, even if we had a 5 or 10% drop in occupancy, say at 85% versus our target of say 95, 96%, that property is still cash flowing and throwing out profit on an annual basis. But if you're thinking about diversifying a little bit into single family rentals, I would encourage you to look into some of these groups and maybe, some of these REITs like America Homes for Rent, maybe placing some capital in there as sort of a bit of a defensive play, but do it very selectively. At the end of the day, single family rentals, in my opinion, do come with more risk and more exposure due to the fact that, if you only own one or two and something goes wrong, you might have ruined your whole investment, or the whole investment might have been ruined by that particular issue. So in terms of diversification, maybe look for a REIT that you can put a little money in to take advantage of the economics and the upside that's happening in the single family rental space. But in terms of direct passive investment, I would be thinking about multifamily or another commercial asset class that you like that has similar good economic drivers that you believe in for your investment strategy. Now, what's our playbook for the next 6 to 18 months? So, we underwrite by the market, right? And when I say the market, that sub-market, that local market, we have to go broad out and then start by drilling down. It's like we're peeling back the onion and we want to get to the core. What's really happening in that area? But we also have to understand what's happening in the larger metro area. So we're looking at current lease trade outs, neighborhood level comps, and assuming conservative rent growth, right? Because of this increase that could come through additional competition from single family rentals. We stress test everything, our occupancy, what's our break even occupancy, what happens if there was a down building, and what kind of insurance do we have? And rest assured, we always have insurance to not only cover replacement if there is some sort of a storm or fire or some sort of a damage that takes a building down, but we also have loss of income insurance. So if something were to happen, our investors are well looked after due to having incredible insurance that will cover us while that building is being rebuilt or getting back into usable condition. We also stress test our financing, and bottom line is we only take fixed rate debt. We have reserves for our CapEx, our renovation budget, and we're definitely making sure we're staying really tuned into what's happening in the insurance market and making the choice on which markets we invest in based on where we know we won't be exposed to extreme increases in our insurance. We obviously want to target tailwinds. Where are the tailwinds occurring? So favor markets with durable demand drivers, jobs, right, in migration, and pragmatic permitting, right? Atlanta, Tampa, Charleston will always remain on our radar screen because those markets cover those needs. And then we watch the pipeline, right? We're looking at what is going on with build to rent deliveries. What are the institutional buyers looking to buy? And would that impact or put any pressure on our investments? So end of the day, some key takeaways. Mega investor story is real, but it's kind of localized and it's a lot smaller in terms of the big picture. Once again, owners that own over 1,000 homes are 1% or less of the ownership share of single family rentals. So, that's not really the true story here. The true story is that more people are learning and tuning into real estate as a great way to diversify their investment strategy. Single family rental institutionalized really started post 2008 with groups like Invitation Homes, America Homes for Rent, and Colony Homes, but big owners still hold a minority share overall. And your sort of edge comes as an investor by really studying that market by market underwriting, making sure any operators you do business with are conservatively underwriting, making sure they're taking on fixed rate debt where you're not going to be exposed to swings in interest rates, and that they're making proper adjustments for future insurance and taxes. So bottom line, book a call with us. We'd be happy to walk you through our investment strategy and how it could benefit you and help you grow wealth. And know our stated goal is to double your equity within 5 years. So if you are interested in learning more about this topic or want to just talk about investing strategies, go out to fulloutinvesting.com. That's fulloutinvesting.com. You can review a sample deal deck we put together. So you learn a little bit more about our sort of underwriting strategy, our business plan, and how we go about finding these incredible deals. Most importantly, you can book in a time to talk with us to learn more about what we're up to. If you like this content, please like and subscribe and share with other high net worth individuals that you think could benefit from it. We love and believe in you. Keep dreaming and investing big.